Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about Trump preparing for a possible shadow Fed presidency to bring down mortgage rates. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah. I got to tell you, having the President of the United States share your article in this environment has been absolutely a joyful experience.
Oh, yeah.
The messages range from very hateful to very happy to congratulations to what the hell's going on. But it just reminds me, if people don't know me, I like detest politics. I
It's
don't
true.
care about it. Don't watch it. Don't watch TV. I even have friends that I've gone to their weddings that I will never talk to them ever again because all they want to do is talk about politics. I've deleted I've deleted their ability to message me, call me, or anything. Unless I see them on the street, I will never talk to them because they want to talk politics. So in this case, today's conversation is actually going to be like why Trump sharing my article really got me thinking that he is prepping himself and his administration to start the shadow Fed president premise. Because you and I, while we were talking yesterday, we always say that, man, anything could happen. President Trump was meeting with Powell the exact
Yes.
time that, we were talking. And then people started mentioning about it. And I said, I retweeted a lot of people saying, hey guys, it's not shocking that the president of the United States shared my article on Truth Social, left it up there for 18 hours before, tweeting anything else. What do they call it actually on Truth Social? It's not
Is it
tweeting, it's like truth posting
retruthing?
or something like that.
Retruthing or something?
Yeah,
I don't
retruthing,
know.
yeah. So tactical, right? I don't care so much about an answer. I always want to figure out why. That's why we always say we want to be the detective, not the troll. And I believe that he is prepping his team to get ready to start the shadow Fed president movement going out in the future.
It makes sense timing wise because, Powell's term is up in 2026. And so we're close enough to that. Plus, he wants to move markets. I mean, Trump wants the bond market to be like, you can believe in this. And I can't do anything to Powell. He's tried and tried. He tried, just like you said, just the other day. Powell's resolute, so his options are limited.
So for those that might not know what we're talking about, in October of 2024, Besant talked about we believe that we can imply a shadow Fed president, meaning that he's going to be the next Fed chair and he's going to talk the markets down by implying that they will cut rates aggressively or moderately or whatever when he's there. So bond traders, and this is a good lesson for everybody. Why haven't there been any bond vigilantes? Okay, in the history of America. Okay, so we're having this discussion. The 10-year yield's at 4.39%. What the hell happened to the deficit and the tax cuts? And the bond market is going to go against us. Bond traders are here to make money. They've always been here to make money. They're not ideological people, right? Ideological people trying to make money get their handed to them, right? And they get out of a job. So bond traders will go with where they think they can make money. This is why we always talk about channels with the 10-year yield, right? This is why in the last decade I said, hey, listen, we're just going to range between 1.6 to 3%. Bond traders went with that. All we heard about is deficits, we're broke. We barely, stayed above 3% for any kind of duration. But here, bond markets are in a range that is perfectly acceptable. Like as the labor, today the GDP came out 3.8% GDP growth, right? By the way, for any economic nerdy people, we imported growth. This means that the trade data was really tilting the data back in Q1. It's really tilted this report. So average it out. Not much is happening, but be careful on reading about wild GDP data, both negative and positive. But here, the bond market isn't doing what the Fed or what Trump wants. For the longest time, Pulte was talking about, President Trump is, cutting spending, and 10-year yield is down, mortgage rates are lower. Now it changed on Sunday when Pulte talked about we need the Fed to cut rates. And then Trump puts my article up for 18 hours, then he meets. This is tactical. This is all a tactical setup because I don't think the trade war is going as good as he wants, and he wants rates to go lower. And I think this is the groundwork of setting up for the next stage of getting the shadow Fed president into there.
Okay, so a couple of things. People may not know what article you're talking about, so talk about that and then define bond vigilantes.
Okay, so last Sunday, when this comes out, it's going to be Monday morning. But the previous Sunday, Pulte came out and said, the Fed needs to cut rates. Enough's enough. So we wrote about that on Sunday. And then the day that Trump meets with Powell, that morning, very early, he tweets it or truth posts it, whatever they call it, leaves it there for 18 hours or so a very long time, meets with Powell, tells him you got to cut rates. You're wrong. So a bond vigilante is a boogeyman that was supposed to, like, bond market is going to sell the 10-year yield and force the government to spend right. Now, people could say that in Europe, the UK had a bond vigilante moment. Remember, we're the US, we're not the UK. And for about 60, 70, 80 years, people have said that the bond market is going to regulate government spending. They're going to shoot the 10-year yield higher, and there hasn't happened. So when I say that for people, why haven't we seen bond vigilantes when supposedly we've been broke since the 1930s or 40s, whatever, especially after all the World War II spending we've done? Because bond people are here to make money. Right? You as a bond trader are going to make money. You're not going to, if you're an institution and the Fed is cutting rates and you're trying to say, I believe in the principle, you're going to get fired. Homie, you're gone. Go back to your wife and go, honey, out of principle, I was going to sell the 10-year yield and short it. Oh, yes. Get out. That's why you haven't seen bond vigilantes. It's a nice boogeyman, but it's never been here. So in this case, the 10-year yield, how it's trading, looks perfectly fine. So he wants it lower, right? And he knows that if he can get the Fed to just cut 1%, that trading bandwidth where you can get yields can come lower. I'm telling you, Trump would be perfectly happy if the 10-year yield was probably at 380 to 425. Its spreads were normal. That's probably all he needed. That obviously hasn't worked. So in this context, I thought about it. You wouldn't share my article and then go meet the Fed unless you have something in the background. And I think, today, by the way, no one talk about tacos to the president, please. Any reporter out there, do not ask or talk about tacos. What is occurring is that China, for example, is being stubborn. We haven't had a lot of trade deals. So every month that goes by, we get closer and closer to the midterm election. So, and plus the courts and what's going on here, what can he do? What law permits him to do what? It's getting a little bit hectic. So I think he feels much better because he saw this during COVID. He saw the US economy outperform with lower rates. He's not quite sure if that can happen here. So I think this was just a groundwork to, if things don't go for him, then, the shadow Fed president theory, whoever he wants to pick is going to come out there and go, hey guys, listen, bond traders, I know you're here to make money, guys. None of you are principal people. There is no bond vigilante. We are going to cut rates and get ready, and I think that's the mindset of what we saw in the previous week.
So from your perspective, once he starts this, which we haven't really seen yet, I mean, because you think it's going to be worse, right?
Unless somebody else, he's only really brought him up, which is funny because Kevin Warsh is one of these guys who just constantly bashes the Fed and then now wants to be ahead of it. So there's a lot of people who just really don't like him for that. In any case, he's the person that Trump has talked about, which means he's probably made a deal with Trump. Yeah, I'll do what you want.
So if you're out there, you're sitting there, you're in real estate, you're in mortgage, you're like, just tell me, when are rates going to go lower?
No, Sarah, you keep on asking this question for that. I tell you, until the labor market runs. So here's a really good example. This is a really good example. Today, inflation data. PCE inflation headline, 2.1%, core 2.5%. we're pretty much at like the bottom end range of inflation. By the way, we should ban all men from doing dual access charts because, by the way, everyone said, Arthur Burns in 1970s, we're going to have the second wave of inflation is going to start in 2024. Guys, it's literally June 2025. And if we don't have a trade war, we're not even talking about inflation anymore, right? It's just the trade war is the reason that, the Fed has raised their inflation expectations. So the growth rate of inflation looks really tame. Like if you saw that, you're thinking, wait a second, is the Fed really behind? And the Federal Reserve might say, yeah, maybe if we didn't have to worry about this trade war, we may be talking more dovish. But in any case, bond market didn't really care. There was not too much action on Friday morning after the report. So the growth rate of inflation has fallen. But what have we always said? Paper, rock, scissors. Sarah Wheeler, the bossy boss. You keep on asking me the same question. I keep on telling you, labor over inflation. Jobless claims is ticking up, the 4-week moving average. So we're building a little bit of a higher base, but we haven't broken yet. And that's why I've always said since 2022, a lot of people were going to think that if the growth rate of inflation fell, rates would go lower. But this was always about the labor market because the Fed made policy about the labor market, and 65 to 75% of where the Fed funds rate and 10-year yield of mortgage is still Fed policy.
Where I think one of the confusing things is like, this has not been a normal year for many reasons, but the tariffs, right? The trade war, the Godzilla tariffs, as you call them, on, off, and now like this further thing with China, because I think people thought, okay, maybe we are going to see the imports from China become normal, which would stave off some of that unemployment. And now it seems like that's back on. It's very hard to know what the unemployment situation is going to be like. What's the next report? When's it going to finally come through?
This is one of the reasons why the Federal Reserve has said we're going to sit and wait. Now, if jobless claims data is at 289,000, we're having a different conversation. But the 4-week moving average is around 230, around there. So to them, they've always said, remember, the Federal Reserve finally came out in public and admitted it. Jerome Powell said on TV, he said, oh, by the way, we track jobless claims and it's still low. So there are labor triggers. I would say that the last jobs report, so this week will be jobs week, residential construction workers had a slight decline. So we're keeping an eye on this, but the U.S. economy is one bad bleep, man. Oh, goodness gracious. You think about a 14-year period where we've had some of the most biggest bearish people who sold their soul to the devil to prostitute doom porn 24/7 for 14 years and to absolutely get their heads handed to them in the United States of America. And by the way, if you're a guy over the age of 50, you're done, you're cooked. So I tell you, younger men, please do not follow your elderly brothers or fathers or bosses who are telling you the Fed is destroying everything. You have one life to live. They are too old. They're done. They're finished, right?
Wait now. Aren't you going to turn 50 this year?
I'm going to turn 50, but I'm not an anti-central bank person.
That's
right?
true.
Guys, it's not, listen, not all doomers are anti-central bank people. There's a lot of crybaby progressives out there, but all anti-central bank people are doomers. This is nothing. These people are crazy, right? So for the younger generation, this is a dying old man cult. And they got some crazy old ladies with them too. But in any case, you don't want to follow this crew. You have the privilege of living in the United States in the 21st century. You won the golden ticket, man. Go back to like the 1700s. I mean, things used to be really tough, right? And now you got it. You got air conditioning. You got AI apps. Oh my God, Sarah, I got an AI video creator. Lord have mercy.
We are all, no one is safe.
You can't give me an AI like things, but now I got an AI. Oh man. Oh, you should like handcuff me, don't let me use the phone anymore. In any case, when we think about the U.S. economy and how resilient it is, and we were joking about this on Friday morning, what are people not getting? It's what we talked about. It's the honey badger labor market. And if people go back to all of our work going from the COVID-19 recovery model, when we retired that model on December 9th, 2020, we outlaid the case for a labor recovery that nobody is ever going to see, that we should get all the jobs back lost to COVID by September of 2022, roughly got that right. We're going to get 10 million job openings. We got up to 12 million. The labor market is tougher than what people, because the U.S. economy is tougher. And why is the U.S. economy tougher? Qualified mortgage in 2010, the 2005 bankruptcy reform laws. If we are a consumption-based economy that has deficit spending, because we're elderly, like people like the income data came in really strong. You could look at it, the Social Security. We have money into the system. So you've got to break this. Something's got to break this. And this is why this is why I could understand why a lot of people went full 100% recession, because they thought the trade war in itself, if Godzilla tariffs stayed 100%, that would be a shock that the economy. But we are one badass economy, man. We are one badass. Don't waste your life looking in the mirror and go, oh my God, everyone's broke or something like that. So we have labor triggers. We have early labor triggers that have worked for decades. Jobless claims have to start perking up to a certain percentage, tied to the civilian labor force. If you nerdy people know what I'm talking about, that's worked post-World War II. We look at residential construction workers. We did saw a decline. We're keeping an eye on that. And if you follow that, that is a functioning model. So whenever you ask me, when are rates? I say rates can stay in a range, right? Oh, the forecast for 2025, 10-year yield 470, 380. We got what, 479 to 387. Mortgage rates 7.25 to 5.75. We took everything down. If the economy is breaking, it could get us there. Why? The only two times mortgage rates got near 6% were both economic growth scares. Silicon Valley banking crisis, and then last year when, the labor data was getting revised lower and everybody was saying the recession started in October of 2023 and oh my God, and that didn't happen. So have faith in people that have models, Sarah Wheeler. You and I talked about that the first time we were on stage together.
Listen.
Believe in people who have economic models because they're not ideological people, right? They just simply look at it, and certain things have to crack before we get there. So rates just stay in a range, right? And if you guys look back at just look at a 10-year yield chart for the last 5 years, waves, channels, okay, Fed policy, economic expectations for inflation growth, all these things. It's stayed in that range for a reason.
I mean, it's amazing, and the economy being so strong, the honey badger labor market, which I think is still one of my favorite descriptions that you've come up with.
Oh, we brought the GIF out today when a honey badger was taking on a lion, and it's it's 2025, guys. It's 2025. So many people put everything into the inverted yield curve, which is a market related, which is even part of the 6 recession red flag model, but the labor triggers don't break. And if you don't have labor triggers breaking early, this is why we always show those residential construction charts. When you visually see it, it's so funny. Not a lot of people have ever seen that chart. When they see it, they go, wait a second.
Well, I mean, this is good. This is very good. It's good for our country, all that stuff. It's just not good for mortgage rates. And this is the hardest thing about being in an industry where it's so tied to rates, is like, it's not like we want, I hope a lot of people lose their jobs. But unless some people lose their jobs, unless something happens, we're going to be at this level.
And the second article I ever wrote for HousingWire is that a stronger economy might not be good for housing because rates will go up. And that's why I like to do that existing home sales chart going back to 1968, where you see sales fall as rates rise, and then all of a sudden a recession happens. And what happens during a recession? Why do home sales tend to start growing on a recession? Because rates fall, right? So you build a period of time where wages grow, household formations grow, you have a lower sales base, rates fall. And I mean, think about it in this way. The home builders, the new home sales data hit a multi-year high in the sales print, and they're still in 2019. They are still elevated versus the existing home buy. It's sub 6% mortgage market. That's just the way they did. So I could totally understand the frustration. It's like you sit here and you see this is happening, and you see the new home sales sector all the way up here. And, the existing home sales quite doesn't have that. And that's one of the reasons why I think Trump, in the background, since this has been the baseline case for them since the start, as an administration, they went in and said, hey, if we could bring mortgage rates down and people start buying homes, we could really push that as a success, because that hasn't been happening under Biden and stuff. So, but trade wars aren't easy. Economic cycles aren't easy. You can stick to your models and dive yourself into the data, and people have lives and nobody wants to do that. But somebody like me loves this stuff.
So you do it 24/7. Well, thank you so much for guiding us through that. Who knows between now and when this actually publishes?
Yeah,
Because this
it's going
is
to air on Monday, and who knows, 27 crazy things can happen over the weekend, and this is that. But the main point of this podcast is that if things don't go right, let's kind of get prepared for a shadow Fed president run here, because this is something they talked about before Trump won. When Trump was winning, Mnuchin, the old Treasury, God, I missed. Mnuchin would have been great. What would have happened? He's talking about yield curve control. We don't want the 10-year yield above 450. So you can see this is part of the game plan, and it looks like, hey, if Powell isn't working with us, we'll start the process. And Trump said that a few weeks ago. Why would I fire him when I could replace him very soon? So just think about that. If the 10-year yield doesn't go down and mortgage rates don't go down, don't be shocked about this whole shadow Fed president. I know a lot of people didn't take it seriously, but you can't fire him, and with the court saying you can't, this is the only option he has. And Trump has the personality to do something like this, so.
He does. Yes, he does.
Yes.
Well, thank you once again. Everyone go look at the tracker too, because I know it's going to be amazing. Most up-to-date data you can get on the housing market.
Yes. And one last thing, we're laughing because, Mike Simonson and myself work together, but it's funny. There are a lot of people out there that don't know Mike and I actually work, and we work off the same data lines. The way it's funny. The way Mike does it, Mike is purely just working off of his inventory data. And the way I do it is that I incorporate my economic models into the tracker, but we're both basically working off the same data line set. I think the only difference Mike and I really had this year is that my price forecast was lower than his to start off the year. But outside of that, we have the same data. We're working off the same things. We're the only ones that really look at the tracker before the weekend. So it is funny to me that people, Mike's a much nicer man than I am, so me, I just want to go after everyone. I want to get every man in America, put him in front of a camera, in front of his wife and kids, and get them to forecast and model. And Mike's a gentleman. Me, I just want war. So our personalities make us seem that we're like in two different, but we really are working off the same data.
You absolutely are. It is a strength for us. Okay, Logan, have a great weekend. We will talk again soon.
Pleasure.